Hello all and welcome to this very special broadcast that we have at BloombergQuint. As all of you know, and because we had told you about this on all our social media platforms, that we're going to be talking today under BQ Conversations with the top think tank of IIFL. And we have all three of them here to talk about various facets, right? I mean, you've heard Nirmal Jain enough number of times now on our platform and other platforms with his thoughts on the markets, but he's had a conversation with Prem Vatsa about 2 days ago. So it'll be interesting to hear Nirmal's thoughts and what did he make of that conversation as well. It's awesome to have Venkat joining in as well and talk about his experience of how businesses are shaping up and what NBFCs are going through, as well as markets. And Karan, being Karan, will probably tell us about his thoughts on markets, asset allocation, and lots more. So, gentlemen, all three of you, thank you so much for joining in. Appreciate you taking the time out. Nirmal, let's start off with you. Do you think the markets are in a state of fear? Or do you believe that even if that is the case, global liquidity and the measures that are being taken up and the gradual reopening of economies might actually keep the sentiment better?
So the way markets are behaving, they don't seem to be in the state of fear at all. So markets actually have held up quite well. And Indian markets have shown a lot of resilience in the face of whatever negative news has been coming on COVID or likely slowdown in the economy. So markets are, I think, driven by expectations of a V-shaped recovery as well as liquidity, which is flowing in all the emerging markets. And domestically also, people have savings, so they are putting in the market or investments. Interest rates are down, so that's why equity markets are getting relatively higher allocation. So markets are, I would say, in the state of hope rather than fear at this point in time.
Are there clouds on the horizon, though, Nirmal? I mean, today the RBI governor mentioned that the GDP growth rate for sure will be, we'll see a contraction in this year. The China-US spat is gathering some storm as well as we speak. And there are other issues. I read an article yesterday on our website about the Indo-China stress as well poking up a little bit. Do you think all of these can spoil the party? If we can call this a party in the first place.
Yeah, so I think it's a very cloudy horizon at this point in time. And there are a few silver linings in that cloudy horizon, because otherwise everything is looking bleak. But at the same time, when you look at it, there are a few positive things about India is, as you know, crude oil prices, even at $30, $35, relative to medium long-term averages, they look very good. And that augurs well for India. India also has, a younger population, entrepreneurial population. We have seen in the wake of demonetization also. So they have resilience. They can bounce back very quickly. India can attract a lot of capital in this kind of world where liquidity is benign, and relatively speaking, India may become a better destination for investment as compared to China. And the other part, the first early news of monsoon also is very good. So there are quite a few silver linings. And even if you look at the virus and the impact, then India has, people will say that, okay, testing is much fewer here. But still, the fatalities are, compared to other countries, we have done better. Whether it's early lockdown, whether it's hot weather, whether it's our immunity, or whatever you say. And now, I was just looking at the numbers. So India is just about 10 days or 11 days behind New York when we look at the first 100 cases and from their progression. So, I think that India should, come out relatively better in this world. One has to be a little optimistic. And even you talked about Prem, his message was also very clear that in 35 years, he has seen many crises. This too will pass, whether it takes a few weeks or a few months, but things will recover. The world is not coming to an end. And people who can, withstand all these probably will have a much better opportunity and much better gain later.
Venkat, do you want to add something to this? Again, I take a leaf out of the meat today, and I think the governor kind of referred to the fact that the markets and the economy have a bit of a dichotomy, not that we haven't seen such situations in the past. What do you reckon could be happening to the BFSI space and thereby the collateral damage that could come in, and are markets taking it too lightly?
See, if you look at the entire BFSI space, then this is one sector which plays a very important role. If we have aspirations to become a $5 trillion economy in the coming years, and in such a scenario, financial services will play a very important role because such a growth of the economy cannot take place without a proper and a robust mechanism of disbursal of credit, because credit plays a very important role and it is like the lifeline of the entire economy. If you look at what the governor also said, that the RBI is there to take all steps and measures to make sure that this lifeline of the economy does not get choked. And I think to that extent, the government in conjunction with the RBI are taking all steps to make sure that this pipeline keeps on moving. Coming to the markets part of it, I think the entire weightage of the financial services of the BFSI space was actually at about 35-36%. And that is seeing some kind of sell-off, and now it's down to the mid-20s. And there are two reasons for this selling. One is because passive ETF flows are there selling a lot. And recently, we had come out with a report which talked about the overall influence of passive flows in the Indian markets, because in the run-up also, the passive flows played a very important role because the same stocks were kept on getting purchased into. So if you look at the overall situation, I think as the RBI governor himself acknowledged, that the economy is facing a rough spot. And but we have seen such crises in the past, and I just want to share with you experience of one of our own subsidiaries, the microfinance sector. In the last 10 years, microfinance sector has faced challenges, but after every challenge, it has come out stronger. Because the fact of the matter is that credit dispersal at the bottom of the pyramid is required, and it is required because not only for job creation but also for consumption, and both these things are they play a very pivotal role in propelling the economy forward. So I think we are going, as Nirmal said, there are clouds on the horizon. The economy is going through difficult times, triggered by a pandemic of an unprecedented nature, and there are silver linings, of course, because history shows that after every crisis, mankind emerges stronger.
Yeah, well, the fingers are crossed that would indeed happen. Let's get in Karan in the conversation as well. Okay, Karan is unmuted. I was about to ask him to do that. Karan, good having you as well. Just put this into perspective from what the globe might be looking at as well, and thereby what could happen. Because one is the talk of the ample liquidity in the system, but there are enough and more governments which might need liquidity in the current scenario. And two, we are seeing some issues surrounding the geopolitical conversations. I mean, US, China, US, Russia, India, China, etc., etc. How can all of that impact different markets and thereby India?
I think globally things are looking obviously a little nervous, but if you honestly look at 12 months, 6 out of 12 months, there is something or the other going on. But I think three things we need to be careful about. Obviously, I think debt across many countries, including the US, is at all-time highs. Having said that, the ability to refinance their debt till the entrepreneurial spirit kind of comes back in the US is very, very high. US-China, a little bit of push and pull continues. I think the geopolitical situation does cause a little bit of stress. We're seeing the Hong Kong Hang Seng down 3.5-4% today on account of possible law in retaliation to the US legislation on Chinese stocks. Overall, I think there will be a little push and pull, but extremely unlikely for it to become a whole widespread kind of battlefield, especially given the fact that all countries, including ours, are equally battling with issues like COVID and so on and so forth. From an India perspective, I think our biggest strength is domestic consumption. And that, I think, is continued to be a measure of big strength. Even in 2009, 2010, I think India relatively as a market outperformed. I think what will be critical for India is the savings as well as the consumption to come back. Much more important than the entire globe trudging in the same direction. So I think India, to a certain extent, will be decoupled. How fast will it happen? And how fast and quickly will consumption come back is something which we'll have to wait and see. Ample liquidity stays, but where that liquidity goes is equally important, because as of now, the broad feeling of not wanting to take any risk is extremely high, and therefore it is keeping the liquidity very tight in very few corners, and therefore not encouraging either any massive capacity building or any kind of, if I can put it this way, discretionary consumption. Without the lack of those two, it's difficult to get back demand in the economy. And I think that is finally going to be the final factor which will influence how long it takes us to recover. What we've seen in the case of US and China, early signs of, in some senses, some kind of buying coming back faster than we had earlier anticipated. Whether it lasts its course or is something which is more of a turnaround, revenge kind of 2-3 weeks kind of immediate buying, is something we'll have to wait and see. But if demand comes back and sustains, I think we'll get out of this much faster, irrespective of the geopolitical situation.
Okay, so maybe the key factor would be how soon can demand come back, and I think that's what all of our experts seem to be suggesting. By the way, all three of you, I can see you, so if you have a point to make while I'm asking the question to somebody else, please do let me know as well. I have a bunch of queries across our social media platforms which I'll take to. I think one question that I would have had, and which is what a lot of people are asking me to ask you guys as well, is something that I'll put in right now. For any normal investor, Venkat, Nirmal, Karan, either of you can come in. Any of you can come in. For any normal investor, the thing that everybody asks is that why should we have this opinion of long only? That buy it every day. Is there a way to tactically wait for the storm to pass and maybe buy at tactically better levels? Even if you want to stay invested in equities, what's the need of buying right now? Any of you can dwell upon whether, I know it's difficult to time which is the right time to buy, but could we have better times to invest in?
So I can take that first, or no? So I think from our perspective, Niraj, I think it's a very simple it's a very simple answer. I don't think the markets are extremely volatile. If you look back in history, it can fluctuate. If I just use price earnings as a variable, it can fluctuate between 9 times at the bottom to 27, 28 times at the high. It's extremely difficult to decide at 11 times or 12 times whether the market will go to 9 times or not. The only way to break that puzzle is to essentially have a process and a discipline. If I was to use price to earnings and price to book, and I'll just, to keep it simple, use price to earnings for a minute. Between 17 to 20 times, 85% of the observations in the normal curve are between 17 to 20 times on the PE multiple basis, right? So south of 17, your probability of getting it right is incrementally higher. North of 20, your probability of making superior returns is incrementally lower. Now, whether you buy at 16 times or whether you buy everything at 9 times, okay, it's virtually impossible to decide. But from our perspective, 17 to 20 times, we'll be close to invested where we want to be invested. North of 20 times, we'll keep reducing. Okay, markets can go up to 27, 28 times. You'll feel as if you made a wrong decision if you sell a little bit at 22 times, but the market eventually ends up at 27 times. Similarly, if you buy a little bit at 15, 14 times, you might end up buying all the way to 10, 11. But on the way back, it'll be impossible to decide that the market would have gone to the lowest of 9. So I think overall, if you can follow a little bit of discipline, and there are many strategies like these, price to book in a similar vein can be 2 times to 2.5, 3 times. But that's something which we need to figure out. And most important is to follow a discipline.
Nirmal, you wanted to add something to that?
See, I want to add that none of us has a crystal ball to know at what point in time it'll bottom out and you should buy there or even near the bottom, because the number of trades that happen in millions of trades is less than 1. So I mean, if you're so lucky, then you're better off buying a lottery. So it doesn't work like this. And as you know, Karan said that you keep allocating assets. So if you're following a PE model, then you reduce your asset allocation to equities as the PE goes up, and you can increase it as it goes down, because all game of probabilities. And nobody can have any certainty on what is the best day to buy. It may be today, it could have been yesterday. And all the successful investors world over, from Warren Buffett to Prem Vassar, everybody else, nobody says that we could time the market all the time. But the time in the market that they spend makes all the difference. So I think all your viewers and all equity investors should understand this, that although all of us want to do this, but doesn't work like this in practical life.
Okay. Venkat, the counter to this, and again, I'm glad that all of you said that it depends on when demand picks up, but the way the SME and the MSME space has been hit as well, it doesn't quite recover with a whiff, right? It takes a really long period of time, which is difficult to ponder over. What's your sense? Have you guys tried to estimate the damage and the time that it could take for this leg to recover?
See, if you look at all the commentators who talk about, there's an alphabet soup of recovery going around. There's a U-shaped recovery, V-shaped recovery, W-shaped recovery, L-shaped recovery. So I don't want to add my contribution to the alphabet soup. So all I want to tell is that in India, if you go back in time, and I can share with you some experiences, is that every time there's a crisis, the Indian entrepreneur who typically represent the SME or the MSME space have shown tremendous resilience and ability to come back much stronger. So in the last 3-4 years, across India, we had demon, we had an entire GST rationalization. India was hit by many natural calamities. We had floods, we had cyclones, and in different parts of the country. And after every crisis, the Indian entrepreneur has come back much stronger. So my guess is that I think we have to wait and see, as Nirmal said in his opening remarks, how this virus pans out, and when we see the flattening of the curve, and how this entire lockdown is removed. And I'm sure we ourselves have got experiences from our own neighborhood, how the vegetable vendor has now become a distributor of medicines, and people find ways and means to survive and grow. So my guess is we should wait. We have to wait and watch and see how the lockdown is removed, and how the liquidity is flowing in the system, and if there is ample measures to take to ensure that liquidity flows to the right segments, I will not be surprised to see a much sharper recovery than what people are expecting right now.
Okay.
I'll just add,
Please.
2 months ago, we all underestimated the impact of virus or the damage it can cause. Am I right? Most of us did not expect it to become so widespread and so long style. So it's like a market in a way. When sometimes you underestimate the rally, and then when everybody becomes optimistic, then you are overestimating. And the same on the downside. That 2 months ago, everybody was underestimating the impact of virus or the damage it can cause, and today, world over, it might be peaking out now, or already would have peaked out, but the fear is at its peak, and people might be overestimating the damage. So if it very quickly fizzles out, then the things can recover quicker. So what will happen? You try and see it this way. Of course, there's a 2-3 months of loss, and there's a demand damage and all those things. At the same time, there's a huge stimulus of various types which will keep coming, whether the rate cut. Historically, if you see last 50 years, whenever interest rates have come down, so Indian economy would have gone into recession or a cyclical downturn many times. But all the recoveries have been primarily led by lower interest rate. And as we see that the interest rates keep coming down, the environment becomes normal, then that is where the animal spirit can come back and things can recover with a vengeance. But we have to wait and watch, because still it's too early to say that this is a time for recovery. But let's see what happens in the next few weeks.
You reckon, Nirmal, that lower interest rates can compensate in part for lost jobs and salary cuts as well? Because, frankly, the consumer spirit might have taken a big beating compared to the previous ones, because 2008 also, not too many people lost their jobs. Institutions got hit, but a lot of other sectors were okay.
But, India recovered very quickly. So in 2009, 2010, India became, as Karan mentioned, that for India, our biggest strength is domestic consumption. And other than crude oil, even if you cordon off India from the rest of the world, I think we are pretty much world in ourselves. So our advantage is that 1.3 billion people and 1.3 billion consumers. So it can recover. It's not something which is I'll write it off so soon.
Okay. Karan, come in. You mentioned some data. I borrowed a line from a report that I read day before yesterday, that if we look at the last few years as well, overall consumer credit growth had tapered down in the past few years. I think slowed to an average of 13% versus an average of 24% for the period of September 16 to 18. We are anyways in that slide, and now we've been hit by this. There have been job losses. Why would consumer credit pick up, even if the initial 1-2 months might see the spurt of pent-up demand?
So I think consumer credit, I'm not saying will pick up in 1-2 months. I think 1-2 months is too small a measure of time, right? First, I think demand has to pick up first. Capacity building has to pick up first. Obviously, we've got a certain amount of capacity built. The demand has to first come in to meet the current capacity. And as far as credit goes, you've got challenges both more on the asset side, but a little bit on the liability side also. Let's not forget that. The last 14 months, especially post the IIFL crisis in September, has been extremely challenging for NBFCs, even on the liability side. It's not only been challenging on the asset side. So both put together, I think we may be in a muted credit environment, especially in terms of incremental consumer credit for the next 6 to 9 months. But I think there will be a little bit of pent-up demand, and there will be a little bit of incremental credit. May not be in percentage terms, may not show you growth over the last 3 years, but I think in absolute terms it'll come back. And eventually, as happens in cycles, over a block of 5 to 7 years from the peak, we will see a growth of 10 to 15%. But it's unlikely that on a year-on-year basis, you are able to track a 15% growth in consumer credit.
Venkat, the other fear that a lot of people have is that while valuations are in favor for financials, let's start with the big gorilla in the room, big elephant in the room, right? That the valuations might be, optical valuations might be in favor for some, but the extent of real damage to financials will not be known until August and September. So how do you even pencil in past valuations to current multiples and try and decide whether these are good times to buy into some of these? Because even though the weightage might go down later on, for now they still remain the most heavily weighted index on the bourses.
See, what is happening to this entire BFSI segment is most people are now worried about the extent of credit losses that will come in the third quarter or fourth quarter of this year. Because as of now, there has been a moratorium for 3 months and then one more moratorium for 3 months. So, and the fact of the matter is that you had 2-3 months of lockdown, which has clearly hurt demand in a very big way. So if you look at the valuations also, most of we have seen a significant erosion of valuation. And at this point in time, it's very difficult to do a crystal ball gazing and say that all the bad news has been factored in. So at this, and we have seen the overall weightage coming down from 35 to 25%, and whether the mean is 20% or 25%, I think that's a big conjecture. So effectively, what the point we are trying to make is that BFSI is a very important segment in the overall marketplace. We have aspirations to take the country to a $5 trillion economy. This $5 trillion dream to be converted to reality, credit is a very important. Credit has a very important role to play. All the BFSI segment tend to disburse credit and make sure that the credit reaches the lowest common denominator, and hence this is an important segment and cannot be ignored. To whether this at 150 rupees State Bank is a buy or it can fall further, it's anybody's guess, because that will be driven by a multiple of factors, including liquidity flows. But at this point in time, the valuations are reasonable. They are not maybe a screaming buy, because there's uncertainty on the extent of damage that can come in the form of NPAs in the next 2 quarters. But at this point in time, they are not statistically valued, which was the situation 3-4 months ago.
Okay. Now, just before I steer the conversation to maybe what bond should one be in, right? Because asset allocation is such a big way, and you guys at, for example, IIFL Wealth do such money management for so many large riches of the country. We really good to get that perspective as well. But Venkat, just one quick follow-up. A lot of correct thinking should be preventive in nature, right? I mean, Munger says that, Buffett says that. If we want to be preventive, in order to make sure that large losses are not there, even if gains are not there, what should their investor keep in mind? What should be completely avoided at the current point of time?
See, at this point in time, given the fact that there are 10 stocks or 15 stocks which are holding the Nifty up, but in the broader market, in the mid cap or the small cap segment, there has been a massive carnage. If you look at the small cap or mid cap index, they are down almost 50, 60, 70%. So at this point in time, I think most of the damage has already been done. And already you're sitting on a portfolio which is bleeding and you have taken a hit. So that brings us back to the original point which you're trying to make, which is the advice to the investor is to do a proper asset allocation. So you have to put money in equities, and within equities there are 3 buckets, which is a large cap, mid cap, and small cap. And you should make sure that you're allocating assets smartly to all the 3 buckets. Because in the year 2018, when most of the small cap and mid cap were on tear and they were on rallying so sharply, because now most investors tended to over allocate to this segment. And last 2 years, these 2 segments, mid cap and small cap, has borne the burnt of the entire carnage. So effectively, what we are trying to say is that look at your portfolio on a holistic level. Make sure that you put some money in debt, put some money in gold, put money in equities, depending on your risk profile, and stay the asset allocation for the long course instead of being tactical and trying to catch every bottom and every top.
Okay, so that's with regards to equities. Nirmal, what pond you jump in is probably more important than how well you can swim. What would you recommend? Within equities, Venkat has given us a slice. If you agree with that, non-equities versus equities, gold, real estate, and I'll ask this to Karan as well to dwell upon a bit, because I'm sure he has some thought there, but Nirmal, to you first. Any thoughts? There is also gold, which is the fanfare right now, Nirmal.
So, Niraj, asset allocation has to be different for every individual. You can't have a one size fits all. You have a different risk appetite. I have a different risk appetite. Your income, your goals, so your not only your willingness to take risk, but your ability to take risk is also different than mine. So, I mean, somebody is a wealthy person wants to take risk. So I don't think that you can ever have, not only in this kind of crisis, but ever a very clear formula that can fit all. But given that, I think obviously on a larger scale, which Karan can share some data what we are doing with our wealth clients. At this point in time, there's a balance. I think if I look at myself or the way I look at the things, fixed income and equity both are balanced. Gold can be a small part of it. But maybe Karan, why don't you share how we are advising our clients and what is a broader mean or median asset allocation at this point in time?
So I think, as I said, I spoke about it earlier. I think for us, asset allocation is the key. While every client doesn't end up having the same asset allocation. But in our mind, we can go back 5, 10, 20, 30, 40 years. But asset allocation is more or less the determinant for 80% of the return of the portfolio. The quantum of money allocated between fixed income and equity eventually decides or is the reason for attribution for nearly 80-85% of the portfolio return. 10 to 15% obviously can be improved on account of timing by following a process and discipline like we discussed before. On the equity side, it can be a combination of price to equity, price to book. On fixed income, you can define credit and duration as the key variables. And the remaining 5% really, we believe, comes out of instrument selection. More often than not, a lot of us, including our clients and us, end up spending some time on the inverted manner, where we end up spending 90% of our time trying to decide which instrument to invest in, as opposed to deciding where to allocate the assets. Most of our clients today realize that choosing a bucket of 7 funds versus investing in the ETF itself, the average of the 7 funds and the return of the ETF more or less ends up at the same point. Overall, I think today we would be around about 60-65% in fixed income, 35-40% in debt. Most of our clients look at their portfolio as a method of wealth preservation as opposed to a method of wealth creation. When I say wealth preservation, it doesn't mean keeping your capital intact. It means ensuring your capital is intact, plus protecting for inflation as well as small consumption needs. So the targeted return tends to be in the region of 9 to 12%, depending on the asset allocation. And the power of compounding obviously kicks in. So it's a process which is driven by low volatility, ensuring consistent return, and most importantly, ensuring a compounded return on your entire portfolio. On a large portfolio of 100 rupees, effectively it becomes 800 rupees if grown at 12% over a block of 12 years. Most clients in history, if we go back, have not been able to kind of multiply the portfolio by 8 times over a period of 12 years. But all it needs is a return of 12%, but consistently without too much volatility, and most importantly on the entire portfolio. So those would be the governing principles. We are not necessarily looking for a single idea or a single stock which can hit the ball out of the park, but ensuring that the entire 100 rupees is invested in a way which will allow the client to be invested for a medium to short term, a medium to long term, without having to see a large drawdown on his portfolio.
So 30 to 35% is equity, right now? 60
to 65% would be fixed income, 30% would be equity, and 5% would be real estate.
All other assets, yeah.
And no gold.
So gold is there, but it would be less than 1%, 1.5%. Gold is typically used as a hedge, as opposed to looking at it as an instrument of return. So in case the world in itself kind of, for that, you see, there's nothing called a zero probability to anything, right? So today I would assign potentially a 2.5 to 5% probability of the virus potentially becoming a much larger demon than what we have been able to anticipate. In that event, obviously owning a little bit of gold is something which can be recommended. So people use it more as an instrument of hedge as opposed to looking at it as an instrument of superior return.
Yeah, no, I was also wondering if indeed the currency, it could serve as a hedge against currency depreciation too. But okay, so I've got the broad asset allocation that you guys think, and you guys advise some of the biggest names, so it's well taken. Thanks for that. My final question to each of you, we've done about 25 odd minutes, one last set of questions. Assuming that all of you are in agreement with the larger allocation numbers that Karan mentioned, which is 30-35% to equities, when does that inch up? Is it dependent on the return of demand? Is it dependent on the animal spirits coming back? Is it dependent on flows coming back to India? What is it? And any of you can start.
So I think the visibility of corporate earnings should improve, and the volatility or the risk should reduce. And that obviously will be driven by the demand and companies getting their margins back. So obviously stock markets will look ahead. They won't wait for the actual results to come, but they will look at the analyst upgrade of the results or earnings upgrade and stability. So if the volatility goes down and the outlook for earnings improves, there's a time you can probably improve asset allocation a little bit. But I don't think it'll swing significantly. It's not that even the best of the times will go to a much higher number, maybe. So current will range from what, 35 to 60, 65 in the best of the times?
Yeah, so the way we would do it is essentially if there's a client who ideally is sitting on a 50-50 allocation with 50% equity and 50% fixed income. Today, he would be around about 35% in equity, which means 70% of his target allocation. But effectively, like I said earlier, we go back to the PE model. So theoretically, if you look at Nifty and take a broad forward earnings benchmark around about 525, 550, below round about give or take 9,300, every 500 points correction, we would keep adding 2.5-3% till his 35% moves up to 50. Okay, so effectively from 9,300, 9,400, approximately add 2.5% at 8,900, 9,000. Again, add another 2.5-3% at 8,500, 8,400, and more or less progressively follow the curve. Similarly, on the upside, if for any reason at all in the world, the market suddenly moves up to 10,800, 11,000 over the next 30 odd days, okay, we would similarly kind of start reducing if it goes north of 10,800 or 11,000. Okay, so I think we work in a window where we would typically never go down below 25% if the client is allocating 50%, and we would never go above 60%. So effectively, if the markets do go down to 10, 11 times, we may end up in a situation where the client at that point of time becomes 35% debt and 60% equity. But for that to happen, the multiple on the markets would need to be closer to the 10, 11 times.
Okay, well.
So in the current scenario, at a Nifty level of, if it does, I hope it doesn't, but if it comes to 6,500, 7,000, now that's really when the client would become inverted in terms of allocation. 65% to equity and 35% to debt.
Well, if it does the other thing, Karan, which goes to 10,800, and the way Venkat was smiling as well, I can safely tell you that the alcohol is on me. I'll come to your office and pay everybody to that. But okay, so Nirmal, let's give.
Niraj, we hope that we get it in the foreseeable future in the next few months and not in the next few years.
Yes.
Inshallah, cross fingers for that, and hopefully a lot of things have to turn right, and they do. But so okay, we've got a broad portfolio allocation as answer from Karan, and Nirmal stated about maybe look at corporate earnings. Venkat, what would you look at? What would be that one factor that will make you believe that okay, let's get out, and you don't get a chance to answer about corporate earnings or about valuation, something else?
I think the thing that will make me increase my equity allocation significantly is news that a cure for the coronavirus has been found. On that day, I think people will go and buy equities, lock, stock, and barrel.
Well, that's a white swan that everybody is hoping for. Let's see if it happens. But gentlemen, I know I could frankly do another half an hour, but I'm sure there are time constraints to each of you as well. But thank you so much. This was pretty insightful in more ways than one. Really appreciate your time and look forward to have you more often.
Thank you so much. Have a nice day.
Thank you.
Have a good day.
Thank you, everybody.
Thank you. And
how many places can you be at